How safe is your bank? How safe is your broker, your insurance, or your 401k? Dr. Martin D. Weiss and Mike Larson of Weiss Research have just completed an urgent webcast, a public service for investors and savers to give you the answers you so desperately and urgently need. In this free 1-hour video, they will provide you with frank, honest, unhedged answers you need to get yourself and your family through the most devastating financial crisis since the Great Depression with your money completely intact. The following is an excerpt from the program answering questions on the safety of brokers in this unprecedented crisis.
All right, if you mind, I've got another one of those questions coming in from the Instant Messenger. And this person said he's reviewing his company's list of 401k options, but he's confused between money market funds and fixed income or bond funds. And he wants to know if the bond funds are safe or not.
Oh, why don't you take that question yourself, Mike?
Sure, okay. Bond funds can invest in long-term bonds, and we feel those long-term bonds can put your money at risk for two primary reasons. The primary reason, or the first primary reason, is the degree that the fund puts your money in the bonds of weak or failing companies. You can lose money on those company bonds just like you can lose money on their stocks.
Really? Absolutely.
Yeah, and with so many big and supposedly strong companies going under, there's a larger risk now than it's almost ever before been in our
Motors,
lifetime.
Ford.
Exactly.
Yeah.
And you know, the second risk that you have is the interest rate risk. If interest rates rise, the price on lower yielding bonds in that fund are going to fall, and naturally. And so you net it all out, and the bottom line is that you can lose money even in bond funds.
Perhaps not as much as in a stock fund, but,
yes.
you can lose money.
Exactly.
Okay, so let me sum up by giving you a kind of priority list of choices for maximum safety in your 401k. Does that make sense?
Sure, I think that works.
So first choice, Treasury-only money market funds, if the 401k offers you one, which unfortunately is rare. Second choice, a government-only money market fund, if they have one. Third choice, a standard money market fund, which I'm sure they'll have. Fourth choice, an income fund that invests exclusively in U.S. government notes and bonds and nothing in corporate bonds. Fifth choice, an income fund that invests mostly in U.S. government notes and bonds and as little as possible in corporate bonds. So you see, the priority here, Mike, is short-term over long-term, because you don't trust them more than a couple of months. That's a factor in safety and liquidity. And the other is highest quality possible, which starts at the top with Treasury, then goes down to other governments, and then to high-quality corporates and so forth.
Yes, that's right. And, you know, we've covered the investments in the accounts here, but, you know, earlier we were talking about maybe also covering the type of account itself, if you wouldn't mind maybe for our listeners doing that.
Sure. Well, of course. On that level, I do agree with Susie Orman. If it's a 401k, go ahead and continue investing. Take advantage of your company's matching program. Take advantage of the fact that your money can grow without the drag of taxes. Just make sure you're putting the money into the safest choice available to you in that account.
And, you know, while we're on the subject of accounts, what about an IRA or maybe a 529 savings fund you might have for your kids' education?
Same thing. Those accounts are great ways to save. Just make sure that the money is in the safest and most liquid investment that's available to you in those accounts, okay? I can't stress enough. It's absolutely vital to check your accounts right now and see what's in them. Most people I talk to are shocked to see how much they've shrunk. If you do nothing else as a result of this event today, as soon as you have a rally in the market, contact your broker or your HR department or the administrator and say, I do not want to withdraw my money or incur any penalty. I just want to move my money out of stock investments to safer cash-type investments like Treasury bills or money funds, etc.
Okay.
And then, you know, at that point, you just follow the priority list I gave you.
Great. Yes.
Yeah.
Okay, Charles is asking essentially the same thing. He just wants to know, can I invest in short-term treasuries from my IRA?
Absolutely.
Martin, if you don't mind, I just want to switch tacks for a little bit here. We're getting some questions on insurance now.
Just some questions?
Well, most people, even now, just seem more concerned with their bank accounts than with their insurance policies.
I think that's a mistake.
Now, that's surprising. Why would you say that?
Well, because the insurance industry doesn't have an efficient guarantee system. In the early 1990s, several giant life insurers failed. Executive Life of California, Fidelity Bankers Life, First Capital Life, Mutual Benefit Life. And the state guarantee associations, which are supposed to work kind of like the FDIC, they choked. They simply didn't have enough money or even the ability to raise enough money to cover all the policyholders with cash value policies that got caught in those failed companies.
So what did they do to handle that?
Unfortunately, they didn't do very much at all. The authorities redefined the word failure and said that technically the insurance companies really didn't fail, and so that way they were able to legally avoid triggering the state guarantee mechanism. And instead, they simply froze the accounts of 2 million people.
2 million people. I mean, that's so hard to stomach.
Yes, 2 million people. And months later, when they sorted everything out, they offered policyholders a choice. Either accept as little as 50 cents on the dollar, sound familiar? Or accept a replacement policy with far inferior yield and terms.
Now, that was a number of years ago.
No, maybe for you it was a number of years ago, but for me it was just like yesterday.
Well, really, I mean, do you really think that can happen again this time around?
For the companies that fail, yes. For the companies that don't fail, it's not an issue, of course. But let me give you a breakdown of which policies can be affected and how, starting from the most vulnerable to the least vulnerable. There are 3 general categories of policies. The first kind is the most vulnerable. That's fixed annuities and whole life, sometimes called universal life.
So fixed annuities and whole life. Okay.
Right.
Why is that?
Because these are the cash value policies. Fixed annuities and whole life are the policies that which you have your savings in the game, your own money in the game. Where does that money go? It goes into the insurance company's own balance sheet. So if their balance sheet goes down, your investment can go down with it.
Okay. All right. Now, that's the first. What about the second category of policies we're talking about here?
The second kind of policy is a variable annuity or a variable life policy. In variable policies, your money does not become a part of the insurance company's portfolio. It goes into separate accounts, like in a 401k. In fact, your money actually goes into a kind of a mutual fund.
Okay.
And like the 401k, now you're responsible for the safety of your money, and you should check what you have. Check their menu of choices, and like we talked earlier about the 401k, switch to the safest choice.
The same list of priorities, the first choice, the second choice.
Exactly the same one we looked at before.
Okay, now, but wait a second. What if the insurance company that you're using fails?
You mean in a variable annuity?
Yes.
As I said before, your money is in a separate account.
Okay.
And we have a good example of this in the 1990s. We even saw the failure of a major variable insurer, and none of those policies were frozen. Investors could get their money out despite the failure in that insurance company.
Okay, all right. But what about the third type of policy we were discussing?
Term life. Now, that includes health insurance, auto insurance, home insurance. These are all term life policies. But there, your risk is greatly reduced because you're just paying for the insurance. It's not an investment. Your savings are not tied up in that policy.
Okay, so what you're really saying here is as long as I have a variable policy or a term policy, you're essentially saying I or anybody listening just doesn't have to worry about their insurance company.
No, wait a minute. You're putting words in my mouth.
Okay.
You know, all insurance policies do have an insurance component. That's what you're buying it for, right? So to make sure your insurance is good, you still need to do business with a strong company. Plus, if your insurer fails and you have to switch to a new company, you may not qualify for a similar policy. And depending on your health condition, maybe not you personally, but depending on if you're older, like me, and your health condition is an issue, you may not qualify at all for a new health or life policy. So no matter what, you don't want to get stuck in a failed insurance company.
You have been viewing some segments for the Weiss Research Emergency Question and Answer session. To view the entire program right now on your computer, just go to the website on your screen. That's moneyandmarkets.com/TV.